Hello everyone, good evening. Today we are going to start accounting for share capital. It is a very important chapter in class 12 of CBSE board. So before starting the chapter accounting for share capital, we need to understand the meaning and definition of the term company. So what is company? According to Professor Haney, a company is an artificial person created by law having a separate entity with a perpetual succession and a common seal. And as per section 2 subsection 20 of the Companies Act, a company is a company incorporated under this act or any other previous company law. So, what does Professor Honey want to say? A company is an artificial person, means that a company is a non-biological person, unlike human being, but it is a person. And as human being is created by God, but the company is created by law. In India, it is the Companies Act 2013 and any other previous Companies Act. And um, a company have a separate entity, which means the entity of a company is separate from that of its owners or shareholders, and the company has perpetual succession, which means the company continue to run its operation even if any of its shareholders or owners become died or become incapable. And even if all the members of the company become died or incapable, the company still continue to exist its performance until it is ceased to exist its performance by law. And a company has a common seal. That means a company can enter into any agreement as an artificial person with any other company or any other firms, and for that purpose it is used as its common seal as a signature. And as per section 2 subsection 20 of the Companies Act, uh, the Companies Act 2013, section 2 subsection 20 of the Companies Act 2013 created a company. But apart from this act, there are many other previous Companies Act like Companies Act 1956 can also create an old company. So let us understand from this diagram. There are three types of firms. First one is sole proprietorship firm. In sole proprietorship firm, there is only one person, such as Mr. Ram, Mr. Shyam, etc., and he introduces his capital and started his business. So he is the only one owner of that of his firm, and he is known as sole proprietor. And in this firm, he holds all the liability and all the liability, and he also enjoys all the profit of his business. So, suppose that after some time he wants to expand his business, and for expansion of business he requires much more capital. In that case, he brings 4 or 5 of his friends to invest capital in his business. So all these 4 or 5 friends are now considered as the partners of this business, and when since they introduce their own capital to conduct the business, so they became the owners or partners of this firm, and this type of firm is known as partnership firm. There can be at least 2 partners in a partnership firm, and the maximum number of partners may be 50. But suppose that this company now grows much more bigger and wants to invest in international sector or any other big project. To invest in any other big project, the company requires much more funds. So it is not possible for any single owner or any group of partners to introduce such huge amount of capital to start the project. In that case, the company will allot shares in the market and and collect money by issuing shares to the market, and this money will be regarded as the share capital of the business. And in that case of a company, all the shareholders who are investing in the shares of the company will be treated as its members. So in case of company, there may be numerous owners, and these owners are known as shareholders. and the company has a separate legal entity apart from its owners or members. So let us now understand some of the features of the company. Some of the important features of the company are as follows. Number one, incorporation. मतलब कंपनी का शुरुआत. A company is an artificial person created by law under the present Companies Act 2013 or any other previous Companies Act. As we discussed in the definitions of the company, a company is an artificial person, not a human, not a biological human, and not created by God, but created by law. And this, in case of India, this law is the present Companies Act 2013 or any other Companies Act before this. Number B is separate legal entity. A company has a separate legal entity from its owners or shareholders. So as I discussed earlier in the definition of the company, a company is treated as a separate legal person from its owners or shareholders. That means the legal existence of a company is separate from its owners or shareholders. In case of sole proprietorship firm, although from accounting point of view, the sole proprietors and the sole proprietorship firm are considered as separate, but from the legal point of view, they are treated as the same person. So, in case if the sole proprietorship firm has a huge amount of unpaid debt, then the owners or the sole proprietor can be held legally liable for this unpaid debt and debt can be collected from him either by seizing his property or by some other ways. Similarly, in case of partnership firm, when although the partners and its members, although the partners and the companies are treated as separate from accounting point of view, but from legal point of view, they are treated as same persons. So, in case of partnership firm, also whenever the partnership firm has a huge amount of unpaid debt, that debt can be recovered by selling the properties of the partners or owners. But in case of company, a company is treated as an artificial person separate from its owners or shareholders. So in that case, if a company has a huge amount of unpaid debt, its owners or shareholders cannot be held liable for this, and only the company can be sued by the debtors for recovery of this debt. Similarly, if the company gives some loan or some other amount of unrecovered debt from any other debtors, the company can also sue its debtors from the legal point of view. Artificial person, number C. In the eyes of law, a company is an artificial person who can enter into any conduct business, sue or to be sued for his debt or actions. So as I discussed just a few minutes ago, in the eyes of law, a company is treated as an artificial person, and being an artificial person, a company can enter into any contracts or can conduct business or can be sued or to be sued for its debts. In case of partnership firm or in case of sole proprietorship firm, it is the sole proprietors or the partners who enters into any business or any contracts on behalf of their company. But in case of company, since the company is treated as an artificial person, a company itself can enter into any contract or conduct business or sued for its debts or to be sued for its debts. Perpetual existence. The life and existence of a company is not affected by the death or lunacy or bankruptcy of any of its members or shareholders or all of its members or shareholders. It means that since the company is treated as an artificial person separate from its owners or shareholders, so the existence of the company will remain unaffected by the death or lunacy or bankruptcy of its members, of any of its members or shareholders or all of its members or shareholders. In case if any of the members or shareholders or all, even if all these members or shareholders of the company died or became bankrupt or became lunatic, even in that case, the company will continue to exist its operation by changing their owners. So it is so the company has perpetual existence, and This existence can only be terminated by law. Limited liability. Liability of its members. Liability of members of company is limited to the value of shares subscribed by them or the amount guaranteed at the time of winding up. In case of sole proprietorship firm or partnership firm, the owners have unlimited liability. In case the sole proprietorship firm or partnership firm has huge amount of unpaid debt, it is the owners who are held liable to pay for that debt. But in case of company, since the company is treated as a separate legal person, so the liability of the members or the shareholders of the company is limited only to the amount of shares subscribed by them, or if any amount guaranteed by them at the time of winding up. That means, suppose that Mr. A purchased 100 shares by paying rupees 10 per shares. So in that case, his liability will be limited only to rupees 10,000. That is his purchase value of shares. Or if the promoters or any other members during the formation of the company give any guarantee to pay some amount at the time of winding up of the company, then his liability will be limited only to that amount. Transferability of shares. Shares of any company are freely transferable except in the case of private companies. So, in case of any company, its shares are freely transferable in the share market, and that share can be purchased by any members, and they can also resold their shares to any other persons. Suppose that Mr. A purchased 100 shares of Reliance company from share market, and after a few months, when the share market, when the value of the shares became boom, then he can sell that shares to any other persons also. In that case, the ownership will be transferred by that amount of shares. So, shares of any company except the private company are freely transferable in the market. Management and ownership. Companies are not managed by their members or shareholders, but by their elected representatives called directors. Here, management and ownership are separate. As we see in case of sole proprietorship or partnership firm, the companies are the firm are managed by their owners or partners. They are responsible for any business conduct or any agreement on behalf of their companies, on behalf of the firm. But in case of companies, since there are numerous number of owners or shareholders, so it is not possible for all the owners or shareholders to manage the company. They elected, these owners or shareholders elected some representatives on their behalf to manage the companies, and these elected representatives are called directors. They form a board of management, and accordingly this board of management are responsible to conduct all the affairs of the business. Common seal. Common seal is regarded as the company's signature. It is affected to all important documents of the company. In case of sole proprietorship or partnership firm, whenever a sole proprietor or partnership firm enters into any business or agreements with some other parties, then the sole proprietor owner or the partners, then the owners of the sole proprietorship firm or the partners usually make the signature on the agreement on behalf of their companies, and that signature make the agreement legal. But since in case of company is regarded as an artificial person, so the company so the signature of the shareholders or owners will not be done in that case of company, and in case of company, a company has to make its own signatures in case it's entered into any agreement or any new business with some other parties. But since the company is not a human, so it is not possible for the company to make its own signatures. So in that case, a company has a common seal or a stamp. This common seal or stamp is stamp are used in the important documents as the signature of the company, and whenever a common seal of the company is stamped in a case of any document, then that documents or agreements become legal. Kinds of company. Broadly speaking, there are three types of company. Kinds of company मतलब कितने तरह का कंपनी होता है. So broadly, there are three types of company. Number 1, private company. Number 2, public company. And number 3, one person company. That's it.